Hi everyone, in this video we're going to be taking a look at the study guide here for exam 2 and work through some of the work problems in the study guide, as well as just kind of give you an overview of the first tab, etc. So in the guide here we've got a number of different kind of guidance points, I'll say, or topics here. This 26 is kind of just informing you to keep working through the rest of the problems, but there's 25 other lines here where we talk about things such as in order to be able to answer the multiple choice questions well, this will help guide your studying, especially when it comes to things like looking at your notes or reading the book, etc. So anyway, I'll let you all review through this, but it contains things like making sure that you understand how credit card fees are accounted for, understand how petty cash transactions are accounted for, review research and development costs and understand what they are and how they're accounted for. So FOB, shipping point and destination, etc. Certain concepts to review for the exam, like materiality, conservatism principle, and the matching principle. Inventory turnover ratio. So hopefully that'll help you kind of guide your studying. And if there's a lot in the chapters we've discussed and covered here so far. So I just wanted to try to help you hone in a little bit on specific items in the chapters. So, okay, with that said, let's move on to the work problems tab here. And we've got a number of different tabs or problems here to work on. We've got an inventory valuation method problem here with FIFO, LIFO, etc., a weighted average and whatnot. And then we've got a problem down here with the bank reconciliation. We've got a notes receivable problem. We've got an allowance for bad debts problem, depreciation, and finally a multi-step income statement problem down here to practice as well. Okay, so let's dive in here. Let's start with A. And in this first problem, like I said, it is a FIFO, LIFO type of problem. So I'm going to take a snip of the problems as we go. And then I have a template here on the following, in the following section here that we can use to solve the problem. But snipping it over here from the other tab lets us review the instructions as we go. Okay, so we've got a number of different transactions here, and in our tab we've got specific identification, FIFO, LIFO, and weighted average at the bottom. And so let's start with specific identification. And just as a reminder, with specific identification, we are essentially doing an inventory count at the end of the month, seeing what's actually left in inventory and comparing that against sales and purchases and beginning inventory in order to figure out cost of goods sold and ending inventory. So let's get started with it. So beginning inventory, it says here we had 18 units. Oh, sorry, that's the date here. That was on 5/1. So 18 units at $8 per unit. Multiply those together and get the total cost. Okay, and that was our beginning inventory. Then we had a purchase on May 6th of 23 units at $11. I'm just going to drag this formula down. And then this one is going to be just a summation of the above numbers. So we can put that in right now. Okay, on May 8th, we purchased 30 units at $16 a piece. And finally, on May 16th, we purchased 45 units at $18 a piece there. Okay, so that's all the units there that we have could have been sold or were available for sale during the month. We had two sales transactions here on the 13th. The 13th and the 22nd. The first sale here, we had 60 units that were sold, and the second sale had 25 units. And it gives us the sale price here often in a lot of these problems, and including here, I'm going to copy this times this formula down here. It'll give you the sales price information in some of these problems, and not that is not important to know, but a lot of times for these inventory problems, remember that what we're really interested in is cost. So don't get too hung up on the sales price, and there's nowhere necessarily that the sale price needs to be put in to our other methodologies as we go forward. So don't let that trick you and kind of trip you up. Don't get hung up on the sales price for the other methods. We won't even consider them. We basically ignore them for completing the further parts of the problem. And we don't really, for this problem, really what we're trying to do, and it's typically asked in these kind of problems, is to figure out ending inventory and cost of goods sold, and we don't need the sales price to do that. Okay, so with that said, this is these were our sales though, and the units and all that is important, regardless of whether the specific outcome the specific sales revenue is important. So we had ending inventory here. It tells us we have 25 units from the May 16th purchase. Let's see that one. I'm going to put it in the second spot because the other one is the beginning inventory. So that's the 5-1, just to keep them in order. And it says we have 6 units from the beginning inventory, and we have 25 units from the May 16th. Okay. And what we know when we look up here is that the cost of the beginning inventory was $8 per unit. And then we know that the May 16th purchase cost was $18 a unit. So again, we don't really, we're not talking about sales price here. That's the cost. So just make sure you differentiate that in your mind, and you will do well. I'm going to just take this formula, very similar, and paste it down here. Now we just get sums there. So we're very close now. So here we can see we had 116 units available for sale. We had 85 units that were sold. The difference between those two things, 116 and 85, is 31. And that's what we end up in ending inventory. So that makes sense that those units are there. And then the value of that ending inventory is we've multiplied that by the purchase layers, if you will, different purchase transactions or beginning balance. We've used the cost from there. And so now we know ending inventory value. And so all we have to do to find the cost of goods sold then is to take your total cost of all the goods that could have been sold minus what's in ending inventory, because this is still with us, in the warehouse. And what we want is the portion of this 1687 that could have been sold that was sold. And so we get 1,189. And one way to kind of check yourself, because like I was just saying, really what we're doing is kind of dividing up this 1,687 into what's still here and what was sold. And so if we add back the two things that we kind of split up there, you can see the sum of the inventory and the cost of goods sold, so what's still here versus what's been sold, sums up to 1687, which agrees to the total available for sale amount, that the whole pie that could have been sold during the month. And this little, then we just separate it out. So okay, let's move on to the second part of our work problem here. I'm just going to pull our instructions along with us so we can see them as we go. So here we're going to do FIFO, and in our FIFO version, let's go ahead and put our dates. So this is our beginning inventory. So we always start with our beginning inventory, and we can put in 5-1 here if we want. So it's 18 units at $8 per unit, and then and let's get our total here. So those equals 18 units times $8 per unit, so 144 at the beginning. Then we purchased 23 units, and then we purchased 30 after that. So we had 23 and then 30. Those two are at $11 and $16. And then I'm just going to drag our multiplication formula down and sum these up. Put a little sum sign on there. Okay, so now we can see that and let's put our dates in real quick. So this was May 6th and May 8th. So after the May 8th purchase, out in our warehouse now, you can see we have 71 units of inventory, and the cost in total we paid for all those was $877. And then we have a sale that happens on May 13th here of 60 units. So it tells us how many units were sold, and it tells us, tells us the sales price again. But like I said before, that's kind of a don't let that be a trap that throws you off. It's kind of irrelevant, but it could run you down the wrong thinking there. So in total, we're doing FIFO. So when we do FIFO, remember the main thing about FIFO is that we start at the oldest layer. Here's the different layers, beginning plus 2 different purchase layers. There are different dates with different costs. And with FIFO, we start at the first one and we go downward towards the most current purchase, okay? And so we sold 60 units, so we need some combination out of this 71 that equals 260. So I'll take the 18 and the 23, and those are our first 2 layers, but that only gives us 41, and we're still going here. So then we need, I think, 19 more to get us to the 60 that it tells us were sold, right? So the 60 is told to us, and then we figure out how to make up that 60 from these different inventory layers. And so we needed all of the first layer. I'm going to put in the per unit cost here for these layers. So we used up, like I said, all of the first layer and all of the second layer, because we had 18 and 23. We sold out of those ones. And then the last layer was 9. So let's do our same. Multiply those together, get a sum. So that means that the cost of goods sold associated with this sale in total was 701. So we used up 19 out of the 30 that we had in this layer. That's like all we have left after the sale then is the difference of this layer. So we have 11 units left, right? And that makes sense. We had 71 minus 60. That leaves us with 11 left, and they're all from that last layer. Let's multiply those together. Okay, and then we had another purchase on the 16th. And so we bought 45 units at $18 per unit. And let's just do our formula here, but it does tell us in the instructions what the totals are, so we can check 810. Yep, that's good. So now we've increased our inventory back up. We were down to 11 units, but then we bought some more stuff. So now we have 56 units out in our warehouse. We paid this much for all these units. And then we have another sale on the 22nd, and we sold 25. So we're going to start at the oldest layer that we have available here. So that's going to be 11. And then times, we're going to have the 16. So the whole layer there is gone. And we need to get to 25, it tells us. So we need 14 more units, which will equal 25. And all of those units are coming from this layer now, because we sold out of this one. We picked all those for that portion. But then we get 25. So we took 14 out of that layer, and that leaves us with, this layer is gone, right? We sold all those. This is the sales side, obviously. So we've got 31 units left, and that should agree, if you remember back to the specific ID, all of the units in ending inventory should agree, and everything between the methods. So watch for that. And all of those 31 units, it was 45. We took away 14, and we have 31 left. And they're all at $18. So our ending inventory then becomes $558. And our total cost of goods for the month, then we add the 2 individual sales transactions together. And those are our breakouts. And we get $1687, which again ties back to the cost of goods available for sale. It's just a different allocation between cost of goods sold and ending inventory, basically, when you use the different methods. But we can again see that if you add them together, they equal the whole pie, just like we were talking about above. Okay. Okay, I think that's, there's everything there. Let's pull our instructions down a little farther and go to LIFO. And so for LIFO, very similar. I'm actually going to link up back to some of these transaction dates and everything because it makes it easier here. So I'm just this cell will now equal what we did before, because between the two methods, they don't differ at all when it comes to purchases and beginning inventory and doing that part of the work. So we'll get the exact same. We can actually just drag the formula across now, and that will just keep referring up to the balances here. I'm going to take the formatting of that though, and then we would want to put in our updated. We want to create our own formulas. I wouldn't just grab the formulas from above, just put new ones in, but you can grab the actual metrics or the balances and the amounts because they're the same. But now, then the sales dates will be the same too. So I'm going to take that one. But remember with LIFO, we don't start at the first in, first out. We start at the last in. And so we begin doing our analysis of, how many units we sold with the most recently purchased, right? And so we sold 60. So we're going to start with the most recent layer. And then we need to get to 60 total. So we have 30. Then we're working our way backwards. So we started here. Now we're going to this layer. And it's 23 at $11. And then we're back into this layer here. So that is, where are we at? We're at 53. So we need 7 more. So I'm going to add that there. And all 7 of these are coming from the oldest layer now. And then we just multiply those together. I like putting in these little underlines just to show that it's a total. Okay, so we had, again, starting with the most, you can compare this, here we started with the 18, then we went to the 23, then we went to 30 with FIFO. Here we started with the 30 and went backwards. So we got rid of all the layers, but here we're left with the beginning layer. So at 789, you just carry that over. And then remember that we we had 71, we sold 60. Excuse me. And the whole rest of those, so it's 11 and 7 make the 18 up that were this layer. So all these 11 are at that unit cost, which is $88. Okay, so that's our balance we had after the sale. And then we had in one more purchase. I'm going to make a little more room here. So insert a row and just bring this down one, just to differentiate there. So then on the the 16, 516. Yeah, there we go. We purchased 45 units, $18. Same formula. Let's put some underlines, do some addition. Okay. Whoop. Cool. So now here we are, and then we have one more sale then on the 22nd, and this is going to be 25 units. Again, we're starting at the older layer first. We'll apply those together, and I'm going to add one more row there. Shoot, we might need 2 rows. Okay, so now we've taken 25 out of here. So that leads us to where we still have all the 11, but we have 45 minus 25, or 31 units, which is what, remember that's what we expect given looking back at the problems before, 31 endings. So we put our numbers in there, right? It looks like. Where did we go? Okay, and then so we have the costs here, and I'm just going to copy and paste that formula in. And so total COGS then becomes, it's a little different there. Higher cost, like we assume. But remember that total cost of goods sold plus ending inventory again is 1687, just like it was above for FIFO. Okay, let's go down here a little bit farther and do our final weighted average transaction. And so in this one, again, same thing as the previous, is that we basically follow the same, beginning purchases, etc. So I can just drag that down, drag this over, do summations, and then I want to make it look exactly the same, so I'm just going to do my format painter there. Okay. Real quick. Okay. Great. So, like I said, same thing. I mean, if you wanted to think about it, you could think about the average cost at this point, but let's just come down here and do our sales transaction. We'll see how that is used at that point. And so we, again, same deal. We sold 60 units on the 13th. But here we don't take the cost from any specific layer. We take the total cost divided by the number of units to get an average 12.35 per unit. And then we just multiply that average cost times the number of units. Another way to think about that is doing it up here is if you wanted to see it at that point. When we were here, this is the average cost. And really it updates every time you have a new purchase, basically, but we only really need to consider what the average cost is after when we have a sales transaction, etc. Okay, so we sold 60. We had we had 71. We sold 60, so then we have 11 units, and they're all at that average cost, and we'll multiply those together. Okie dokie. And then we had another purchase. This is the same info as up, regardless here too. It's not that changes at all. So we bought those extra 45 units. So then we have 56 units. At a given, we don't want that one. At a given cost. And then finally we have our last sale. So we have 25 units. Oh, we have to, and then same formula. So we can even just, I'm going to copy this, paste it down here. We can see that it's taking this, the cost divided by the units, dollar per unit, basically, for average, right? And so, yep, we just pasted that down, and it actually went to the right cells without any issue. So we can leave that. So now we're at 1689 of an average cost. Oh, geez. Just trying to make that formatting the same. Okay, and then we want to calculate that out. And then we're going to say we had 56 units. We sold 25, so we have 31 left. So we did that right. Again, remember that's the same in every one. The average cost at this point is 1689. And then our total cost of goods sold and our ending inventory, let's add those together, 1687. So we end up, same in every one. It's just how does it split between COGS or inventory? And yeah, that's a good sign. Okay, so that's how you do all the methods there. A little bit different on each one, and hopefully you guys find that helpful. And let's look at it. All right, so let's keep working through some of the work problems here. Again, I'm going to take a snip of our next problem here. So problem B tells us to work on a bank reconciliation, and we have our bank reconciliation template here. Paste that in. Okay, cool. So let's work on our problem here. So this problem tells us that we need to prepare bank rec, and our bank statement has a $3,000 balance, and our ledger is $1,575. Do formatting on that. Okay. So let's look through our items here. So there were outstanding checks of $2,000. Remember that outstanding checks have been reduced in the books, but not the bank. So we're going to put that amount as a deduction from the bank balance. Like those checks were written, they just haven't cleared yet. So we want to be careful not account for that if we were to write additional checks. There was a non-sufficient funds check of $50. So that means that a customer paid with the check, and essentially that check bounced, or it was not cleared. It was a bad check. And so now we're going to record, we have to take that balance out because we thought we had cash, but we really don't since it's a bad check. So we reduce our cash back, and we would record a journal entry related to that with accounts receivable. Okay, there was a deposit in transit of $500. So similar to the outstanding checks, but positive instead of negative for the bank balance. There's an error on check 55, which was written for $400. It was incorrectly recorded as a debit to AP for $40. Okay, so we need to reduce our check, or we'll just say check number 55. And so we need to reduce our cash by the difference, which is $360. So I think that should do it there. I always have to think about those for a minute. I think that's right. There was a bank service charge of $15. Let's put service charge. Oh, I'm going to do these negative. Okay, and then we had an EFT receipt of $300 and interest revenue. So we hadn't really, known about those increases till we saw the bank statement essentially. And let's cross our fingers and hope that our balances reconcile here. Woohoo! Yeah, there you go. So they're both to 1,500, which is what we'd want. And that is how we kind of handle one of these problems essentially. And then if we wanted to do the journal entries, which I didn't have a journal entry spot set up, but let's do that as well, because that's actually a good practice to do, is to understand the journal entries as well once we finish our bank reconciliation. So bear with me for one moment. I'm just going to make a little journal. And maybe I can put this up here more. Excuse me. Try to get it to where it looks a little uniform with the rows below there. I'll put it down one further. Okay, now we've got slightly larger spaces that we can work in there. 1 second here while I merge all these cells. Okay, so now we just need to go back through and book our journal entries. And I don't know, did it say on here? Oh, April 30th. So it's always the last day of the month when you're doing the bank rec essentially for these problems. And then for all of our positive adjustments to the book balances, we're going to do a debit of cash. And then our credits are going to be all the various things that we recorded here. So we got an EFT receipt. So I'll just put AR. So someone paid their bill basically directly and electronically to us, and we just caught that on the bank statement for the first time. So that customer who paid us, accounts receivable, then would decrease. And then interest revenue, and that should be in our credit spot there. Interest revenue is $50. And then the other portion of the journal entry that we would want to record is the outflows. And so here we would have cash as a credit, and we're going to need 3 other line items there. So I'll do the cash here. Let's delete these. Okay, and on the debit side, we would have an AR because we had our bounced check basically. So now we're gonna, and not, we don't want that negative. We want everything positive on the debits and credits. We're gonna have to follow up with this customer and try to collect that money. So that's what that is within a receivable. Accounts payable will be our 360. I'll get $360 correction. And then finally, debit to bank service charge. I'll just say bank fee expense. $15. Add those up. Oh, we want to have that as a credit though. $425. That should equal your deductions, and there you go. Now your book balance will be $1,500, which is reconciled, and then we just wait for these transactions to process. It's timing difference, basically. That will fix itself and clear itself out within a few days. Typically, hopefully. A lot of times outstanding checks can take longer than that, I suppose, but hopefully that's the case. Okay, that is our, let me go back here. That was our bank reconciliation problem. Now we have another problem here that I'm going to snip over, and it's for note receivable and interest revenue, etc. It's associated with note receivable. And so we have this template here, kind of a journal here to put journals and entries into, and then we have just like a listing of information that we can put in here. And it's nice to have it in Excel in its own spot, rather than a sentence here that we can't access or manipulate in Excel. So our note receivable balance is $75,000. It tells us, and this was on 6/1, and then it was, what's the rate? 10%. Assume the monthly convention. So we're doing monthly convention. So let's take our annual interest revenue would be $7,500, the rate times the total outstanding principal. And then our monthly, then, if we just divide that by 12, is $625. And let's see, what else does it tell us? So that was on 6/1 when we loaned it. Okay, so we need to record from 6/1 to 12/31/24. This is when we, within the year of 2024 that we had the loan outstanding. And then I'm going to put that down here as well, because we'll calculate the interest revenue for that. And then the other portion is from, we could say 1/1/25 to what is this? To 6/1/25. Or yeah, we could say, let's do it that way, 6/1/25, because that will be, what it says in the instructions. So it's exactly a year later, essentially. So the first, so that is 5 months, I believe. So January, February, March, April, May. It's June 1st, but it's right at the beginning of the first day of June. So we don't really count it as that month. We're using the monthly assumption for the timing. So that was 5 months. 5 months here, and then June to the end of December, from the beginning of June, is 7 months. You have June, July, August, September, October, November, December. 7 months. In total, 12, a whole year, right? That's what we're saying, is every year we make an interest payment on this. So now that we know the monthly interest, and then we know the number of months, we can just combine or multiply those. So for 6/1 to 12/31, first part of the part of the term there, we had 7 months at $625 a month, so $4,375. And then for the other part, we had 5 months times the monthly revenue to give us $3,125. And if we look at the sum of those two things, it adds up to annual, which we would expect because that is what we're doing. It's just separating out a whole year's worth of revenue into 2 years, 2 separate recording periods. Okay, so we need to record the journal entry for the first interest payment. But I'm going to go ahead and record all the journal entries here, at least, as of the date that we loan the money, just to put it so you guys can see, so everyone can see and get a feel, right, for what we're doing here. So we have notes receivable going up, and our cash goes down because we loaned it out, right? So we have a receivable, but we'll say loaned money. That's our explanation there. Okay, and then assume we just do we're recording interest once at the end of the year here. Then we're going to record an interest receivable for that portion that we calculated right here, right? That was from 6/1 to 12/31. So at the last day of 12/31, we say, okay, we've earned $4,375 of interest, and that's a receivable. And in the credit spot, we'll do interest revenue. This goes to the income statement. This is on the balance sheet. And we'll say accrued interest. They call it an accrual of interest. It's kind of the terminology there. I'm going to need a little extra room. Let me insert some rows there. Okay. And then our last entry that we need here is going to be the interest payment on 6/1/25. So now we're actually getting the cash coming in, and we're going to have the receivable we previously recorded is going to go away, essentially. And so our receivable was the $4,375. We're going to receive that now on June 1st. And there is but there is also a portion, 5 months worth of interest revenue that we're just going to record when they pay us, up to that point. And that was the $3,125. So then if we add those together, they pay us $7,500 on a year later, right? And we recorded this accrual of interest at the end of the previous year to make sure that we got the interest revenue in the previous year, not in 2025, right? Because it was earned during 2024. So hopefully that makes sense. And we'll do an explanation on that. We'll just say interest payment. So this is really the journal entry that the question was asking about, but I think it's helpful to see the build up to that too, just to practice those. So cool. All right, let's keep going. So then we have another example. I'll go ahead and fill this out here. So $150,000, 8% note. We're using a 360-day convention. And it's a 90-day note. Okay. So our annual interest revenue again is just the percentage times the principal. But and then we're going to use the 360-day convention. So it's divide the annual by 360 days, gets you $33.33 per day. Then, and over a whole year, it would add up to the 12,000. That's how that works, right? So it's just a 90-day note, so it won't even go a whole year. So you're not even going to earn the full amount there. It's going 90 days. Basically, that's going to be like the fourth of the year. Yeah, I think that's right. I'm trying to do mental fractions in my head, but we'll calculate it out. So, but that is the 360 gets us the daily. Okay, and then we're gonna want to let me put some days in here. So we loan the money on 11/20/24. So what we need to get, or 24. That's the starting point, and it does tell us right there. So 12/31/24, and here it tells us in the problem it's 41. I'll just put it in there. It's gonna take up too much space, but I can go like this, which is 41 days. And then there's a number of days to calculate between 1/1/25 and then what's the ending date here? It's not 90 days. So January has 31 days. Let's see here. It's not our total. So we got to figure out what is the day that we actually. I guess it would be just whatever it is minus 90, but we need to figure out what that date is as well. And so this, we're saying in January, there's 31 days. So if I'm going to just write it out over here. So on 11/20/24 to 12/31/24, my slash there. That is 41 days. And then I'm just going to copy this in and use it and say 1/1/25, the first portion, of the next year there, to January 31st is 31 days. And so together that adds up to 72. So we need to get to 90 is our total essentially, or our goal if we're trying to write this out. And so what is that? 18. So we need 18 days will be in February. So 2/1/25 to 2/18. So we know it's to the 18th just because it's 18 days and it's into all. So 2/18 will be the end of the intermonth. That will be the payment date. Okay, so yeah, this gets a little funny. So, but the number of days then here is 41 between 12/31, and then the number of days between January 1st and February 18th. So 2/18/25 is how many? It's the 31 plus 18, or 49. 49 days. And that's including both January and a portion of February. Okay, through 2/18, through the repayment date that we just figured out. And so that was, like I said, or did I have it? No, yeah, it was 31 plus 18, or 49 days. So here's the total whole 90. Half of it, or 41 out of 90 of days is in 2024, and 49 out of 90 days will be in 2025. Okay, so let's figure out what that amount is. So let's take our daily times those number of days, daily interest earned times number of days, adds up to 3,000. So yeah, it must be that's a fourth then. Yeah, so that makes sense. 90 days times 4 is 360. So yeah. Okay, so that's how it breaks down. And I'll just put this in here. And it's just nice to have the data all separated out like this, where it's easier to kind of understand and see. At least I think I like the Excel organization, just having it in something like this, easier to analyze and think about. My perspective. Okay, so let's do our journal entries here. So on 11/20/24, I'm going to take some of the journal entries we had up here. And I'm just going to paste these in. I'm going to change them a little bit, but let's start with those just because they're nice and reusable portions of them. So this will be very similar. We got 150,000, or we can just probably link to our cell would be the better way to do it. $150,000 loan. And then on 12/31, we're going to record that portion of interest, the 1366.67. And got a little funny looking there with the formatting, but that's okay. Okay, and then we had we had the repayment here. Let me just do something here. Sorry, bear with me. Okay. So we had, back to what I was looking at here. I think that's actually working. Okay. Yeah, so we received that, we got that portion of the receivable, then our revenue, which was just, that formula was already linked over. So at the time of payment, which is on 2/18, like we said, 25, that's our maturity date, 90 days later. So they pay us $3,000, and that was, we'll just say repayment in full. Oh, we're missing a piece. I'm like looking at that like, wait a minute, I think that's just the interest. That's not full. Okay, sorry. So the piece we're missing, they're paying us back here, is to get our full amount of our note receivable back as well. So this, I'll just redo the formula. It becomes the repayment of the original amount plus all the interest, or $153,000. And it was just a 90-day loan, like we said. So that's the full amount coming back to us. Whereas in the other problem we looked at, it was only interest that we were accruing, because we were saying it was more than a year when we were just recording interest up here. So this one, we have the full principal coming back to us, like we had the full principal going out at the beginning of each one of those transactions. Okay, so let's look at some other problems here. And the next one we're going to take a look at is the problem D. Grab that guy. There we go. And we have a kind of a spot here to do these entries. And this is going to be calculating the allowance and the bad debts expense journal entries. And so we've got two different methods we're going to be looking at here. And we're going to use the AR method here, and we're going to do the percent of sales down below. It doesn't tell us exactly what the date or the year that we'll be recording, but that's okay. Oh, let me actually do the calculation, then we will put the journal entry together. So let's just put our factors in again, just in Excel here. So we've got them all available. I'm just going to call that allowance, net sales, 250,000, 750, and 950,000. And it does tell us, AR has a debit balance, as it should. Allowance for doubtful accounts kind of swings back and forth sometimes. It tells us it has a credit balance, so that's helpful for us on our journal entry. And sales is always a credit balance too, 950,000. And we are going to say uncollectible, and that will be 3%. So that's our uncollectible portion that it tells us. I guess we should say AR. Then we can go 3% times the AR total. Oops. Let's see our allowance. Sorry, hit some crazy buttons there. Ending AR will be, or sorry, I should say ending allowance and that will be the 3% times the AR, or $7,500. And we can say credit balance, or credit, just to have that there. And then I'm going to make a little T account here just to So you can visualize the journal entry here from the T account perspective. So what we said is the allowance had a $750 credit balance already. When we do the AR method, we are basically calculating a targeted ending allowance balance, so 7,500, and so we need this ending number to be 7,500. So we're going to credit the allowance, but we already have 750 as a credit balance recorded before the entry, so we only need a $6,750 credit to get to the total. Now remember, if it was a $750 debit balance, then we would need 7,500 plus the 750. So we'd have to book a bigger bad debts expense of 8,250 to get rid of the 750 and then leave us with a credit balance of 7,500. But this problem says that the 750 is just a credit balance. So that means, does that look funny to me? Sorry, let me. Font looked weird. Yeah, like I said, that means that we don't have to record as much of a bad debts expense to get us to an ending balance of 7,500 if we already started with 750. So now let's do our journal entries. So bad debts expense, and we're going to say, again, that's the 6,750. This is the allowance T account, but it will be the debit to that credit. So really, here's the credit, and then the bad debts expense was the debit. And we'll say to record allowance. Okay, so that was the AR method and all that. Now, if we just want to do the sales method instead, which is a little simpler, ending allowance, and let's say AR. That doesn't fit on there. Oh well. Anyway, we can just calculate this separately. So we'll say uncollectible sales, indicating that we're using the sales method. And that is 3% of sales is uncollectible. Okay, so it's the same percentage. If it was a different percentage, it doesn't have to be the same percentage. It could be something totally different. Let's say then we'll say sales allowance, so it's a little different, and versus the ending AR allowance, we'll say 3% of sales, not AR like we did before. We get 28,500, and so if we take that, we're doing the sales method, then we don't care about what's in the allowance already, and we just book the allowance amount based on sales, 3% of net sales in this instance. So yeah, we don't care whether if this was our same 750 beginning balance, like we're saying, we would be crediting the allowance for 28,500, and we would end up with an ending balance of 29,250. Okay, so that's the difference between the sales method and the AR method, is that you're using sales and you figure it out, you just put that in as the entry, you don't have to care about what's in the allowance, and it just adds to it essentially what's already there or affects it, if it's a debit balance. And then the AR method, you have to look at the allowance and then adjust accordingly to get to the ending balance you calculate by using the AR method percentage. So cool. Okay, and yeah, that's great. That's those problems, 2 journal entries, and that's what we got there. So just kind of know the difference between the 2 methods and how to calculate those. Okay, let's take a look at our next problem that talks about depreciation. I think I have depreciation here. Oh, that's gain or plus on sale. I don't know if I have a good template for that. Let me see. I don't see one. Okay, bear with me for one moment. Okay, I got it here. I'm going to copy it from a different workbook into this one. Okay, that just popped up. So now let's just put it there. We'll call this tab depreciation. And so, yeah, so we have it snipped still. Hopefully that comes over. Yep, there we go. Okay, so our next problem is a depreciation problem, and that is E. So we're working on letter E here, and let's I've got kind of a breakout here of data as well to do some calculations and show everyone how to get the different depreciation amounts under the various methods. Okay, so here our purchase date. Oh, let's make that. Show where that's currency. Short date is on 5/1/24. We paid $55,000 for this copy machine. The salvage value is $10,000. It's got 2 million copies as its expected total life in terms of units of activity. And the first year there was 125,000 copies, and the second year there were 375,000. All right, and we need to calculate the accumulated depreciation balance at 12/31/2025, so a year and close to a year and a half later, using all the three depreciation methods that we studied in class: straight line, units of activity, units of production. It should be units of activity, and the double declining method. And really, you could have triple declining, different types. Really, declining balance method, I think, is the correct terminology, but we only really reviewed the double declining. So, okay. So with that said, let's keep filling out the data here. So we had the six-year life. Put that in as well, and then we can do our cost minus our salvage value. So that's $45,000. We can turn our years into months. So we'll have those. So 6 times 12, so 72 months. And yeah, I think we have all the factors here that we can go through and do our calculations. And the years here, let's see, I'll just take these. This is kind of carried over from another problem, but I'm just going to clear those out. So it says year 1, year 2. Okay, so what we can figure out pretty quickly for the units of activity is just taking our cost minus our salvage value divided by the total expected units, or 2 cents of expense per copy, right? And then we can use that rate and multiply it by the number of copies. To get our total depreciation expense for those 2 years. And then if you remember how accumulated depreciation works, right, we're just accumulating all of the depreciation every year together. And so the running balance then at that point, at the end of year 2, with both these years and both these amounts included, would be $11,250 at the end. And it's based on the amount of activity there that we had. Okay, so in straight line, we're going to take the total depreciation expense per year. So again, similar starting point, cost minus salvage value, divide by, here we want to get per year, so $7,500 per year. We can divide that into 12 months, and it would be $625 per month. And then we need to know how many months were in the first year. When did we buy? Okay, so 5/1. So this will be, how many is it? I think that's 8 months, maybe? January, February, March, April, and then into May. So yeah, it should be 8 months. So May, June, July, August, September, October, November, December. Yeah, 8 months. Okay. So then we can just say 8 months times depreciation expense per month for the first year, so 5,000. But then in year 2, we can do basically that same formula, but we don't even need that because we already calculated our depreciation expense per year above. So the first year we only got 8 months of depreciation, so 5,000. But the second year we had a full year's worth, or 12,000. Another way to do that, to get the 7,500 would be to take the monthly times 12 to get back to 7,500. But same amount either way. That's just trying to show how it all kind of connects. And then again, we just add up all the depreciation to date to get the accumulated depreciation total, and that's 12,500 under a straight line. And then with the double declining balance, we start with our historical cost. Remember, we don't factor in the salvage value here. And then to get the depreciation rate, we take 2 divided by the years, 6 years, so 0.33 or 33.33% in the first year, or I guess that's our rate, 2 divided by 6 years. Yeah. Okay. And then, so our depreciation expense then for the first year, which is a partial year, then multiplies the book value times that depreciation rate, and then multiplies it by, in this instance, 8/12, because we had 8 months in that first year, like we just were figuring out for a straight line, right? So we used 8 months there. We're doing 8/12 here, but also multiplying that by the depreciation rate. The accumulated depreciation in the first year is the same as the expense because it's just the first accumulation, the only amount that's in there so far. And then to get the book value, we take the net book value, we take beginning book value minus the accumulated depreciation. Then we bring that amount down to the beginning for the next one, the next year, which is a full year again. So here we can just drag our formula down. So it's beginning book value times the rate. Here we could do just 12/12, so right, or just put 1 or something, because this is a full year, so we're not doing the 8/12 for the partial year like we did in year 1. And then accumulated depreciation is just adding that additional year's worth of depreciation in, and then our ending book value becomes the cost, or the amount you put here to start, minus the accumulated depreciation to date, which is here, so 28,519. And you can see the declining balance method put a much more depreciation expense on in those 2, year and a half or a little over than it did, because you can see 26,041 of depreciation in those 2 years versus 11,250 and 12,500. So that's the idea. It pushes more expense in the earlier years and less in the later years. Okay, so that's our depreciation problems. What else do we got here? Okay, I think we're on to this multi-step income statement problem here. And so we've got a breakout of the multi-step income statement here on the SNP here, and then we've got our different statements. We've got our retained earnings statement, our income statement, and our balance sheet there. Okay, so let's start filling out our income statement. And the first thing we want to put in is the revenue. Up in revenues is our gross sales, or just our sales revenue, basically is usually how it's listed out, or sales. So we'll say sales, and that'll be 250. Then we've got sales discounts and sales returns and allowances. Sales discounts was 5, returns and allowances was 5, and that gives us net sales of 240. And then we have not gross profit, we have cost of goods sold, or COGS. And that is down here for 30. and we'll keep it in as I like to have the positives and negatives when it's all within one line, but if it's got its own kind of segment, then even though it's a positive looking number, it is a subtraction from net sales above it to get gross profit. And then for operating expenses, we've got depreciation expense. It's kind of easier to do this when you're working on with your pen on paper, because you could actually mark them off here, but let's just look through. Okay, bad debts expense. That is a part of normal operating expenses. The only things that aren't really going to be in here are things like interest income, interest expense, and gain and loss on sale of assets. So let's keep looking. Amortization expense will be there. We already got bad debts expense. Cost of goods sold is an expense, but it's up here in the gross profit section. A franchise is an intangible asset too, by the way. So is goodwill. So those are two different things we talk about when we get there. Gain on sale will come down here. Here we go. Insurance expense is a normal operating expense. Remember, interest expense will go down here. And finally, yeah, wage expense. So I think our last one there. If we missed one, our balance sheet won't balance, and we'll know something was wrong. But I think I got them all. So depreciation was 10. Bad debts expense was 10. Amortization was 20. Insurance 10. And then wage expense was 75. So I got 125. And then, like we were talking about there, we have gain on sale of assets of 10. And interest expense there, interest expense of 10. Do we have any interest revenue? We did have a little interest revenue. Interest revenue of 5 up here. And yeah, this one, again, we need to make negative because it's all within one section. So if it's in the same row, or same column with other things that are positive or negative, these are all the same sign, if you will. They're all a reduction. This is a addition, reduction to overall net income. So you got to put negative signs when they're mixed in like that. I think we got everything there, and that will make, oh, I forgot to calculate operating income before. So gross profit minus our operating expenses. Really, I should say total operating expenses. So operating income is $85. And then we add $5 onto that for whatever these are representing, if it's in millions or anything, but these are more so for illustration purposes on these examples. About $5 of that, we'll just say that. So it comes out to $90 of net income. And let's keep on moving through, and hopefully we balance, like we said. So beginning retained earnings is $150. Then we have $90 of net income, which subtotals to $240, minus our dividends of 5 is there, and then that gets us our ending retained earnings of $235. Okay, now let's do our balance sheet, and here we've got cash. Remember, we're doing this in order of liquidity. So AR is 30, cash was 25. Let's see, do we have any prepaids? Yeah, prepaid insurance. Of 5. Short-term investment is 15. Supplies is 20. Trademarks, some of these other things will be our assets, but they'll go in a separate section. But we do have petty cash as well, which was 10. Oh, we also have inventory. I need an extra space here. Of 20. So I think that's everything. Okay, let's add that all together. We get 125 of total current assets. Plant assets, we're going to need some extra space here, I can already tell, because we have two different types of assets. We have equipment, and that's a $70 balance. We'll say less accumulated depreciation. Equipment. 10. And then I'm just going to copy these and then update them. That was equipment was the first one, but then we also have a building. Oh, let me fix that. Spelling error. We have a building, and then we have accumulated depreciation building, and the building is 100, and the depreciation for the building is 30. So that gives us 130 for plant assets. Long-term investments. Oh, we have some other stuff too. Sorry, I see land there. We need to put land in with plant assets. For wait, no, we want the ones for not for speculation. Land held to operate the business, so $40. This one, and then I think that's everything there. Let me start looking at. Let me put a couple rows in. Oh, and get more consistent size there. You know what? I guess we don't really need. Well, no, I'll leave it like this. Okay, so that's, make sure your formula includes all the plant assets now that you've put land in there. And let's take just a quick look. I think that's everything. Yeah, okay. Long-term investments, we have the land held for speculation here, and that's 50. So that's speculation is investing essentially. So we've got that noted. What else here? Let's look there and see if we have any other. Oh yeah, here bond. Oh no, bond payable. We got a receivable. That's on the liability side. Yeah, I don't see any other investments, or there's a short-term investment. Remember, we put that up with current assets. Oh, here we go. Note receivable. 8/30/08, and so we can tell this is 12/31. This is supposed to be year one, and so this would be 7 years from now. So it's a long-term asset. If it was going to be paid back in the next year, we could put it up with current assets, but it is not. So we put the note receivable 60 down in the long-term investments section. Okay, I think that's everything there. We didn't need that extra row. Let's add those together. So we have total long-term investments of $110. Now let's look at intangible assets. So for intangibles, we had a franchise and goodwill. Okay. Let's see if we have any other ones. Oh, we do. We have copyright. Just insert here. Copyright is 20. We have a patent. We do have a patent. Okay, one more. A patent of 25. Is there a trademark? There is a trademark. Geez, there's lots of intangible assets here. Throw everyone. So the trademark is 25. Okay, I think that's everything. So let's add all those. So then our total intangible assets is 120. And that should be all of our assets. Make sure I got all those right. 525, okay. Now let's look at our liability side. So remember, on liabilities, we start with the most recent to be, paid essentially. So AP is basically always the one we start with. Wages payable is one that will be paid soon as well. And generally unearned revenue we will include as a current liability as well. And so add all those gets us 65. And maybe I should just take a look, make sure I'm not missing anything. Wages payable. Oh, interest payable. Yeah, I did miss that one. Let's add a row. Interest payable is 15. Okay. Make sure your formula is still getting everything. Yep, that looks good. Okay, non-current liabilities. We have that bond payable, and that's 5169 150. Is there any other long-term debt? No, I think that's it. Okay, and that should be all of our liabilities there. And then common stock, it notes as 85. And then our retained earnings we take down from the retained earnings statement above 235. Add those together. Oh, fingers crossed. Liabilities plus equity, 550. Oh, what are we off by? 25 bucks. Maybe when that happens. Did we get wages payable? That's 25. Yeah, that's there. Patent was 25. We got that one. Okay. Sorry, my video just cut off there right as we saw that it didn't balance. So that's annoying. What did we miss? First thing let's do is just look back through and make sure we didn't have any typos. That sometimes happens. Sales 250 and discounts 5. That looks good. Cost of goods sold is 30. Yeah, maybe there's an operating expense that we missed or something. Looking for 25s. I don't know. Did we put goodwill? Yeah, we have goodwill there. Okay. So anyway, I don't see anything, but depreciation expense 10, bad debts expense 10, amortization expense 20, insurance expense 10, wage expense 75. Yep. Formula works. That works. Gain on sales 10. Interest expense is 10, right? Yeah, there we go. Interest revenue is 5. Add those together gets you 5. So net income is 90. Beginning retained earnings is 150 plus our net income. Yeah, that's 240. Minus dividends of 5, right? Yep. 235. Okay. Cash 25. AR 30. Prepaid insurance 5. Short-term investment 15. Supplies 20. Yep. Inventory is 20 as well. Yep. Petty cash is 10. Yep. Add those together. Okay. Short-term investment. I got that right. 15. Okay. Let's look at the plant assets. Equipment is 70. Accumulated depreciation is 10 for the equipment. And then the building is 100. Accumulated depreciation for the building is 30. So that's good. That makes sense. The land is 40. Yep, operating land. Loss on sale. Did we get the loss on sale in there? Oh, I don't. Okay, there's one issue I just noticed. There's a loss on sale we had. And that's $30 though. I don't think that's going to be exactly our difference. Nope. Now we're off by 55. What the heck? Huh. I don't know. Interesting. Oh, shoot. Loss on sale is a negative. That's one thing. Yeah. Okay. Oh, there we go. Now we're off by 5. That's what I thought was going to happen. Oh, yep. I see it. I didn't put my allowance for doubtful accounts in there. So, shame on me. Let's go to my balance sheet. Here we go. So that's the whole thing about doing our allowance for doubtful accounts. Those journal entries and stuff. Is we want to put it on our balance sheet as a contra asset to reduce the AR balance total. So your net AR then is $25. And now, yes, now our check figure here, assets equal liabilities plus equity. We just had to get our equity to our retained earnings analysis to work by including those items and get all the statements working there. So that's how you kind of have to troubleshoot these things sometimes. If you're having just knowing you're off is super important. If you can identify that you're off, I mean, that's a really good skill. You have to have that skill, and it's a good skill. And once you know you're off, then you can get help or, take a step back, review, do your self review like I just did, but try different techniques to find your problem. So that's just how accounting goes. Just kind of troubleshooting is required sometimes. So. All right, well, let's see. Do we have any additional work problems? I think that's the end of the work problems here. So I hope you guys really found value in this video, and I wish you the best of luck studying for the exam. Reach out if you have any questions, and I'll see you all in class. All right, thanks, everybody.